Great. Thanks, Jim. Hi, everyone. I'm Chris Edson. I'm a senior partner. I've been at Apollo for 13 years. I started in the private equity group, and now I'm the co-head of our US FIG business, and I spent all of my time on Origination Platforms. Mark talked about the excitement at the firm today, about everything going on. I'm really excited to tell you guys today about Origination Platforms. When we think about Origination Platforms, as Mark and Jim both mentioned, there is no excess spread left in liquid CUSIP markets. So we believe that we need to originate this directly. This is basically manufacturing and basically creating the factory to generate these assets on an ongoing and recurring basis to drive excess spread and to effectively create these assets at wholesale prices. And this compares to, we think it's much better than standing in line, fighting for allocations, and effectively paying retail prices. What are these origination platforms? They're living and breathing companies. They have management teams. They have dozens or hundreds of employees. They operate independently, have boards of directors. Some examples of these, we have commercial finance companies like MidCap and Redding Ridge. We have real estate companies like Apollo Net Lease and MaxCap. We have transportation finance and other leasing businesses like PK Air Finance, Merck's Aviation, Donlin, and Haydock. And we have consumer finance businesses like Foundation and NewFi. What's really important is the types of companies that we're looking for are companies that have really long track records, that have really sophisticated management teams with a proven ability to generate stable returns and perform through multiple cycles. A couple of examples for you. Donlin, our fleet leasing business. We acquired this earlier this year. This business has peak losses for the last 20 years of 6 basis points. MidCap Financial, our commercial finance business, has aggregate cumulative losses over the last 20 years of about 35 basis points. PK Air Finance, our aviation debt business, has average annual losses of about 11 basis points for the last 20 years. These are the types of businesses we're looking for. What do these do for Apollo and our clients? For our clients, and our largest client, Athene, they generate both equity and debt deployment opportunities. On the equity side, we're targeting low to mid-teens returns, and these are really downside protected investments. As I just mentioned, we're looking for companies that have long track records of performance of very low losses. On the debt side and the flow side, we're typically targeting high-grade investments, and we're looking to earn an extra couple hundred basis points of spread. And this all aggregates to generate this excess spread-related earnings for Athene and for our other clients. On the Apollo side, because we're driving significant deployment, we're also driving originations and syndications. This is what's really driving excess spread-related, fee-related earnings for Apollo. In terms of quantifying this excess spread, we typically benchmark ourselves versus the liquid indices. And we're finding that most of our platforms are generating a couple hundred basis points of excess spread. How do we do this and what's driving this? It's really 2 main factors. The first is we're cutting out intermediaries, we're cutting out brokers, and we're going direct. And then second, we're providing customized solutions, and we're creating more value for our potential counterparties and clients, and that allows us to charge more. This is my favorite slide. This is why I'm so excited to have the role that I have at Apollo. How are we different than all of our competitors? Investing is about a number of things. It can be about fundamental analysis. It can be about industry expertise. It can be about patience. But really what it comes down to is having some sort of an edge. And we feel that we have a real edge in a couple of different areas. First, in terms of capital structure. Apollo's always been known for capital structure, and this is where we really thrive in these investments. When our competitors are looking at these transactions, they're typically looking for equity investments only, and they're trying to raise third-party capital from others. The problem with third-party capital and third-party funding and third-party debt is it's not always available, it's not always reliable, it's volatile, it's not confidential, and it takes a long time to raise. And what we have is we have the ability to show up and speak for the entirety of the capital structure. And this is something that we find none of our peers are really able to do. So when an opportunity is confidential or requires certainty, we really are striving, and people can't compete with us on these types of opportunities. The second thing that sets us aside is cross-platform collaboration. You'll hear more and more about this from others, but our firm works really well across the board. Our FIG and M&A teams and equity teams work really closely with our credit and underwriting teams. We work really closely with our capital markets teams. And then all of our insurance solutions and other structuring teams that help us manufacture these assets into consumable assets that drive excess risk reward. And we find that most of our deal teams have 50 to 100 people that work on them to get one of these transactions done. And when you compare that to our competitors that typically have 5 or 10 people working on any individual transaction, it really isn't the same thing. The last thing is our investment horizon. Most of our competitors are looking for transitory investments of 3 to 5 years. We're looking for permanent investments into perpetuity. And that makes a really big difference for our counterparties and for our management teams and how we focus on the long term. A great example of this is PK Air Finance, a business we bought from GE Capital a couple of years ago. And most of our competitors had a team of 5 or 10 people, either an aircraft team or an equity team, and they were focused on raising as much third-party capital as possible to try to invest a couple $100 million of equity. When we showed up, we had 75 people that worked on this transaction. We signed the transaction inside of a month, and we committed to the entirety of the capital structure. It was a $4 billion commitment, and we have $2 billion of long-term deployment in this investment. It's not just about the reward, it's also about the risk. And when we have these direct relationships with our borrowers and our counterparties, we're able to do due diligence directly as opposed to reading summary reports. We're also able to control the credit pen and control the credit documentation. And this allows us to put covenants in, something that you don't find in very many broadly syndicated loans anymore, and provide protection for ourselves. Also, by having these direct relationships, we're able to generate recurring origination volumes from the same borrowers. We're able to generate origination income. And by providing these customized solutions, we're able to charge outsized spread on these assets. MidCap is one of our longest performing platforms. We bought this platform in 2014. It's a commercial finance business. It generates ABL loans, leverage loans, life sciences loans, lender finance loans, and real estate loans. And MidCap has grown materially under our ownership. It's grown about 7-fold from an origination volume perspective, from about $2 billion of originations in 2014 to about $15 billion of annual origination volume today. It does this through its 200 employees that both originate, service, source, and manage these assets. I already mentioned the losses. It has an incredible track record for about 20 years, and it's driven material deployment for Apollo and our clients. About $10 billion of total deployment, and what's important to note is more than half of this is for clients outside of Athene and Athora, so true third-party clients that are part of Apollo. And it generates tens of millions of dollars of management fees to Apollo every year. This next one is an example of a signed transaction that has not yet been announced. It was an exclusive opportunity, and the counterparty only talked to us. And they talked to us because they knew that we would be able to confidentially sign this transaction without involving any third parties for any of the financing. So we've committed to the entirety of the capital structure. This will drive $3 billion of deployment for us across the debt and the equity. A lot of our competitors could have made this equity investment, but none of them can make this high-grade commitment to the debt side, which is really what differentiates our ability to get these transactions done. This transaction also will generate $45 million of fee income to Apollo into perpetuity. How we think about growth. We have more developed platforms like MidCap and Redding Ridge, and we expect these platforms to continue to grow in the mid to high single digits organically. Then we have a bunch of high growth platforms. These are some of our newer platforms. And we're targeting the same trajectory that we've been able to achieve with MidCap and expect to be able to achieve it for some of these. And then we have a massive white space opportunity. It's geographically by expanding into Europe and Asia, but it's also expanding into very large asset classes where we have limited penetration today, like consumer finance and trade finance. Jim mentioned the flywheel. We think about this as a positive feedback loop. As we have more and more of these platforms, we have more products to offer potential counterparts. We can expand beyond traditional corporate lending into fleet and equipment leasing and trade finance and other things, and we become much more relevant. And Jim gave the example on Hertz where we were able to create a number of different transactions with them over the past 18 months. And really, when we think about this feedback loop, plus the growth that I talked about on the prior page, we have confidence that we'll be able to more than double our origination volume from $25 billion today per annum to $60 billion in 5 years. The key takeaways on our origination platforms are, first, we're generating assets with excess return and lower risk. Second, we're doing this at scale, tens of billions of dollars today, and we expect to continue to be able to do that. Third, we're generating significant fee income to Apollo. And then lastly, we have significant growth runway where we expect to more than double this business over the next 5 years. So with that, I'd like to turn it over to Craig Farr to talk about our capital solutions business.